Over the next few sessions, we will look at derivatives that are commonplace in equity stock markets around the world. Just to recap, a derivative instrument means a forward, a future, an option, or a swap contract of predetermined fixed duration linked for the purpose of contract fulfillment to the value of specified assets. In the case of equity stock markets, that asset would be equity stocks. Derivative instruments in the equity stock market, such as equity stock options, stock futures and index futures, and the markets where they are traded, have evolved rapidly over the last few decades, primarily to enable participants in the equity stock markets to hedge their risks, that is, protect themselves against potential adverse movement in stock prices. Some participants also use the derivatives market to speculate and gain from the swings and volatilities in equity stock prices over time. Do bear in mind, such heightened volatilities are to a large extent a result of the exponential growth both in volume and value terms in the equity stock markets around the world, and more importantly, a very complex ecosystem of increased trading volumes, investor participations in markets across the world, cross-border flow of funds, technology-based trading and settlement, etc. In the next few sessions, our focus will be to understand the theory and structure of derivative instruments that are commonplace in equity stock markets around the world, namely equity stock futures, stock index futures, and equity stock options. Almost all derivative instruments traded in the equity stock markets are exchange traded. Hence, as we have seen in some of our earlier sessions, the lot size for trading is fixed. Trading is absolutely anonymous. That means the identity of the seller and the buyer in any transaction is not known to each other. Settlements of the trade is guaranteed by the stock exchange, and as a result, price discovery is far more transparent. Participants in the derivatives market for equity stocks include hedgers who wish to cover their downside risk due to adverse movement in stock prices, as well as speculators who wish to make a profit from the swings and volatilities in the market for equity stocks. In a sense, speculators take on what hedgers want to avoid and implicitly therefore become counterparties to the hedgers, which is the case in all derivatives markets. In other words, if a derivative market had only hedgers, it will not function efficiently. If it had only speculators, it would not function efficiently either. So any derivative market needs both hedgers and speculators, ideally in equal numbers, for that market to function efficiently. And derivative markets for equity stock and stock index are no exception to that requirement. In the videos to follow, we will look at 3 types of derivatives traded in the equity markets around the world: equity stock futures, stock index futures, and equity stock options. As a matter of fact, once you've gained an understanding of how derivative instruments are structured and traded in the equity stock markets, you would be in a position to understand and comprehend the structure and trading of derivative instruments in several other financial markets, such as currency futures, currency options, interest rate futures, and so on.